won't the Fed cut interest rates? They're doing this just to hurt Trump. I'm sure you've been hearing a variation of those statements quite a bit recently. And they're probably pretty loud today since the Federal Reserve decided, again, not to cut interest rates. And instead, they kept the rate steady between 4.25% and 4.5%. And the reason why is pretty simple.
The majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target.
That was the Federal Reserve Chairman Jerome Powell this afternoon, and I'm going to talk about how President Trump's tariffs factored into today's decision and what prices are going to start looking like for all of us in a second. But before we get there, I want to point out something very strange that happened at today's Fed meeting. For the first time in 30 years, there were two dissenters when it came to today's interest rate decision, meaning two members opposed the decision to keep interest rates steady. Instead, they believed interest rates should have been cut by 0.25%. Now, in case you don't know this, the decision to cut or raise interest rates is not made by Jerome Powell by himself. He is just one of 12 voting members of the Federal Open Market Committee. 7 of the FOMC members are called governors, and they are nominated by a president, confirmed by the Senate, and they serve for a 14-year term. And the other 5 voting members are regional bank presidents who vote on a rotating basis. So these two dissenters were both nominated by President Trump during his first term. Neither of them explained their reasons for why they want to cut rates, but Chairman Powell said today's meeting was a lively one.
Well argued, very thoughtfully argued all around the table. Good arguments. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock. And it's probably not surprising that there would be differences and different perspectives on that.
Now, let's talk about what the Federal Reserve is forecasting in our economic future. Tariffs, which, according to President Trump today, will start going up on August 1st. No more delays. Now, the fact is, yes, absolutely, these tariffs are bringing in tons of revenue to the U.S. government. But the evidence is already proving that you are the one who pays for it.
The evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer. They may be less than people estimate, or more than people estimate. They're not going to be zero. Consumers will pay some of this.
And we are just at the very beginning of that process. As we see the tariffs take effect on August 1st, we'll start to get a better idea of how much companies are passing the tariff costs onto you. And given that reality, the Fed's goal is to keep this tariff price shock to a minimum.
A reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. In the end, there should be no doubt that we will do what we need to do to keep inflation under control.
Of course, what's keeping inflation under control are these higher interest rates. It's something President Trump has been complaining about, of course, for months. Mostly because he says the high interest rates are leading to extremely high borrowing costs for the U.S. government. He says it's just costing the government too much money. Powell said today, that's not his problem.
We don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.